Welcome to this AmCham Nordic webinar on the road to resilience. Together with Bain & Company, partners Hernan, Saenz, and Andrew Schedel. I'm Steve Brugger, I'm AmCham's Executive Director, and I'm pleased to be hosting this session on behalf of my Nordic colleagues. On that vein, I'd like to invite my colleagues to briefly introduce themselves, starting with Peter from AmCham Sweden.
Thank you, Steve. I'm Peter Dahlen, the Managing Director of AmCham Sweden, and we're pleased to be partnering with Bain & Company and our fellow Nordics on this program, and I'm looking forward to learning about what stands in the way of companies developing resilience. And with that, I'll hand things off to my friend Alexandra.
Hello, everyone. I'm Alexandra Pasternak-Jackson. I'm the CEO of AmCham Finland, and on behalf of AmCham Finland and our membership community, tervetuloa, welcome. It's really a great pleasure to be here with our Nordic colleagues, because after all, the 4 AmChams together is Nordic, and without us in Finland, you guys would be Scandinavian. No, I'm just kidding. Just a little good sense of humor on the afternoon. And with that, it's a great pleasure to pass it over to my colleague, Jason in Norway.
Thank you very much, Alexander. I am Jason Terflinger. I head up the American Chamber of Commerce in Norway. It's always a sincere pleasure to do these Nordic initiatives with my colleagues here and with our joint memberships in tow. I'm the last of the Nordic directors here, so I'm going to risk being kicked by them when I see them in person and name a few of our members on the call, including BI, AIG, Johnson & Johnson, Fast Solutions, Crawford & Company is with us, D&B, Orkla, KPMG, and Ruud Pedersen, and I'm sure there are others representing Norway. All of these companies have been proven to be especially resilient over the past turbulent year, and looking forward to the dialogue with Bain coming up. Andrew and Hernan, thank you very much for being with us. And with that, back to you, Steve.
Hey, thanks, Jason, and thanks, guys, for the intros. Appreciate that, and we'll get you, Jason, don't worry. So with that, we have a lot of participants registered today, so it's important that we all adhere to just a few basic guidelines during the call. Please turn off your video and mute your microphone. To ask a question, use the chat function anytime during the call. The moderators will do their best to ask your question to the presenters. This session will be recorded and shared with AmCham members who are unable to participate with us today. So with that, I thank you so much for your cooperation. A key aim of AmCham's extensive program of events is to educate and inspire the senior leadership teams at our member companies. That's why we're excited to have this partnership with Bain & Company to bring you cutting-edge events with global thought leaders. I'm pleased to welcome AmCham Denmark's board member, Andre Vorboff, who's a partner at Bain & Company in Copenhagen, and he's going to give us a brief introduction to Bain & Company and introduce our speakers today. Andre, the screen is yours, sir.
Thank you, Steve. Hello, everyone. As Steve said, my name is Andre Vorboff. I'm a partner with Bain & Company in Copenhagen and a board member of AmCham Denmark. We're very proud of at Bain & Company to continue our cooperation with AmCham Nordics, to continue to bring events and continue to bring the Bain intellectual property and thinking to share with the members of the AmCham. I'm sure everyone on this call knows Bain & Company. I just wanted to share that we've acquired Quartz Consulting last year. That made us a leading consulting firm in the Nordics with over 500 consultants across 4 offices in Finland, Norway, Denmark, and Sweden. Today, we're going to be talking about resilience. The 2 presenters, Andrew Schedel and Hernan Saenz, the Bain partners. Andrew is a partner in New York. Andrew leads our FS and org practice and is an advisor to the World Economic Forum. Hernan leads our performance improvement practice and also an advisor to the World Economic Forum. I'll pass it on to Andrew and Hernan to talk about resilience.
Great. Thanks, Andre. Thanks, Steve. And thanks to everyone for joining today. We're excited to be here and looking forward to the discussion. I'm going to kick us off here and go through a few initial thoughts on the topic of resilience, and then hand it over to Hernan and hopefully have a good chunk of time for questions and dialogue with the audience. Yeah, I think as a way of introduction, it's fair to say that this topic and idea of business resilience is certainly having a moment. in the wake of COVID. We've been researching resilience, working with clients on resilience, talking in various forums about resilience for many years, but it was really in the last 12 months that it's gone from sort of I'll call it a second tier topic to an urgent priority for most business leaders. And not surprisingly, given the huge disruption we've seen over the COVID pandemic cycle. I want to put this in a little bit of context around some broader trends we see happening in the business world. And the first is that we have been living by many measures in a golden age of corporate profitability over the last 3 or 4 decades. We refer to this as the shareholder primacy era, and we've done an extensive body of research around the trends in corporate profits throughout the developed world, really going back to about 1980. This snapshot is comparing 1990 to 2018. But what we see across, whether it's North America, Western Europe, the developed markets in Asia, Australia, New Zealand, Canada, corporate profits have grown at about twice the rate of GDP in most countries, with some cycles underneath it. And you're probably familiar with a lot of the structural forces that have driven this, including globalization, outsourcing, automation, the rise and deepening of financial services in many of these markets, a commodity boom in the decade before 2008. So there have been many drivers of this, but this has been a kind of steady, inexorable trend, and businesses have scaled up and gotten more and more efficient over time as well. So what's the problem with that? The downside is that in really the last 20 years, what we've seen is, alongside continued growth and profitability, much greater levels of volatility than we saw before. So that global profit pool, while it's been increasing, if you look at what happens in recessions in 2000 and 2008 especially, and then the very different kind of recession we saw with COVID, the extreme declines in profitability have been much greater than they were in previous recessions. And the bankruptcy rate, the failure of firms, has tripled. This is US data, but it's broadly consistent in other markets as well. And then the share of zombie firms, so firms that are unable really even to cover the interest coverage on their debt, has also exploded around the world. Underneath these headline numbers around rise in profitability, there's also an increasing skew in where the profits are coming by industry and by size of firm. So the largest firms in particular have really increased their profitability. And then the smaller public firms with, say, 100 million, 500 million, maybe $1 billion or $2 billion of revenue, have really stagnated on profitability while massively increasing their debt loads. So it's a situation that looks good on the surface in terms of profits, but it's much more fragile than maybe people expected before COVID. The other thing I think is worth bearing in mind is that during this golden age, we've to some extent privatized the rewards while relying on an implicit government put and central bank put to help nationalize some of the downside risks. And so this is a snapshot here. It's a US picture, although there's a similar story we could tell and show in other developed markets around the world of fairly low and one-off levels of government bailouts for a particular firm. You think about something like the US savings and loan crisis in the early 90s. That felt very big at the time, but it's really tiny compared to what's happened since then. If you look in 2008 and 2020, the amount of support pumped into the private sector was equivalent to about 20% of the total cumulative profits over the past 20 years. And if you include quantitative easing, the moves the central bank has made to help really keep the economy moving, it's up to 50%, you could argue. And so I think the question we find a lot of business leaders asking is, what should we expect going forward in line with this continued high levels of government support when we get into more volatile situations? And I think a good cautionary tale, if you want to think about what might happen across broader set of industries and geographies, is really to look no further than what happened with European banking in the wake of the global financial crisis. So financial services and the growth in that industry was one of the big drivers of corporate profitability growth for many decades. Probably nowhere was that more evident in the levels of profits earned by European banks pre-2007. Mid-single digits, in some cases north of 20%. That obviously plunged in 2008, 2009. Since then, it's come back very anemically. And there's obviously a lot of reasons for this: slow growth in Europe, a continued debt overhang, the euro crisis in 2011. But one part of this was dramatically higher capital and liquidity requirements imposed on European banks. And so the question we found helpful to kind of talk through and think through with clients across industries is this picture coming to your industry next? If we're in a world where every 10 years, governments are putting in 10, 20% or more support, what might some of the requirements be around de-risking and building resilience? And the way this has been done in European banking has been very expensive. So are there better ways to do it? Is there a way that the private sector can build in more resilience without going through a picture like this where ROE gets cut by 50% or more? Final thought here before going into some of the specific myths and perspectives on resilience that we found is that it's helpful to think about this topic, I believe, under the umbrella of really, how do we thrive under uncertainty? We're in a world now that is, by most measures, more turbulent, more change happening faster, geopolitical tensions, environmental tensions, technical change, obviously risks from things like pandemics. And resilience is one part of this three-part toolkit we see to really thrive in uncertainty. The first is prediction and the ability to have a point of view or anticipate what might be coming. This one probably gets most of the attention and resources on this page, but while it's useful to go through this exercise, it's really impossible to predict the future and anticipate everything that might happen. I'm sure many companies had a scenario in their risk department for a pandemic, but very few were actually really thinking about it and had plans for what they might do if it hit. The second here is adaptability, the ability to kind of course correct quickly as you see things unfolding that are problematic. And resilience is really about the ability to recover if something goes wrong. The analogy I like to use here is driving a car, and prediction, is headlights and the ability to see what might be coming into the road. Adaptability is the ability to swerve out of the way of an object in the road or to brake in time. And resilience says, if we actually do hit something, are we able to walk away from the crash? And you really need all three. And it's about how do we create the right balance of investments and effort across these three dimensions in a much more uncertain world. So as we did the work here, we really framed this around kind of 5 maybe conventional wisdom assumptions or ways that we see people typically approaching resilience, and what's the problem with each of those, and what are maybe a better way to do it. The first common mistake we see is that often resilience is equated with perfect stability or no volatility, and risk is seen as bumpiness and results, let's say. The second is that resilience is really a balance sheet topic. If we just hold enough capital, everything will be fine. The third common trap we see people falling into is to assume that the next crisis will look like the last one, and it's kind of a limitation or failure of imagination. This fourth one is an organizational issue. So resilience gets lumped in with enterprise risk management. It can get delegated to a risk function, and not necessarily the broad ownership and elevation that we think it requires. Really, this is a CEO and a board level topic. And then the final point, and I'm sure we'll have some discussion around this, is the recognition that there may in fact be some financial trade-offs, particularly in the short term, around this continued improvement in efficiency and that steady increase in profit margin we saw earlier, and really de-risking the company against a broader range of outcomes. So let me briefly kind of tick through each of these, and then I'm going to turn it over to Hernan to share some deeper thoughts on a couple of dimensions. This first observation, I would say, is that part of what has enabled the success of this shareholder primacy era, and what the management system of our companies has done really well, is to deliver predictable results to investors. And there's a high premium that's been put on that. And I think that's a good thing overall, but one negative consequence that comes from it is an aversion to any kind of volatility. And so the degree to which companies have managed resilience pre-COVID, it's largely been around, how do I protect against a quarterly earnings hit? How do I dampen that kind of volatility? And I liken that a little bit to the deductible as opposed to the insurance policy. I'm trying to protect relatively small or maybe medium-sized risks, and I'm ignoring the really existential risks that could put us out of business. So the first step in resilience is just what are the outcomes we're worried about? And I would argue that we need to put more premium on the really big things that could severely disrupt the business, and maybe relatively less focus on how we dampen near-term volatility. The second point here is broadening the frame around the dimensions on which we think of resilience. Really this second column here, financial, is the one that has probably gotten the most attention over time. We have, pretty well-developed metrics and understanding of things like leverage ratios, liquidity. Depending on your industry, there's pretty developed tools around insurance, hedges, futures. And so the financial aspects have a toolkit to protect them. There's been increasing focus, I would say, in recent years on things like technological resilience. Do I have a robust network? Do I have good cybersecurity? Can I get my systems back up if something goes wrong? There's probably been less focus on the other three elements on this page. Strategic resilience. How do I think about the right trade-off between focus and having a narrower and maybe less complex set of businesses, but getting enough diversification in my portfolio, whether that's by industry, customer segment, even major customers, single customer exposures. Operational resilience, which Hernan will talk about in more detail. The severe disruptions of supply chains have gotten a lot of attention, not just from COVID, but also with some of the geopolitical tensions with the US and China. But we haven't seen as many people thinking strategically in the past about operating leverage. How variable or fixed do I want my cost structure to be? If you have a lot of fixed costs and low variable costs, that's great if you're growing. It's not so great if you have a sudden revenue hit. Supplier concentration. We've really honed our tools to drive procurement departments to have fewer suppliers with bigger share of supply. At what point does that go too far, and do we have critical exposure to one or two suppliers? Do we run with enough buffers in inventory, et cetera? And then really one that I think has been neglected is organizational resilience. Do we have a flexible, capable employee base that's fully engaged and committed to the company? Have we done kind of crisis preparedness? Do we have leaders who've been through a crisis before and won't panic in an event? And so all of these dimensions really need to be looked at as part of a holistic review of your exposures and where you might run into problems, and therefore starting to plan for how you would mitigate risks in each of these areas. The third notion I would just say here, and there's a few examples of companies who've taken steps on some of these dimensions. Clearly, a strong balance sheet is a critical part of resilience, but there's a lot of other business model choices that you can make that help bolster resilience as well in other aspects from that previous page. I think Coca-Cola is an interesting example. Obviously, we know them as a really successful, very global, high-margin consumer products company. They I think, benefit from having a product that has relatively stable demand even in times of crisis. But they also, and I think this may be underappreciated outside the industry, have a very flexible business model that is really capital and asset light. They work with local bottlers, but they don't own a lot of the bottling assets. And that gives them much greater flexibility, much more dispersed and geographically diversified production. Nissan, different industry, is another example of making a big effort after they really almost drowned in a debt crisis in the late 90s to diversify production, to work much more closely with suppliers around flexibility and crisis preparedness drills. And they really got the benefits of this in 2011 when the earthquake hit Japan. Toyota, their main rival, was offline for 6 months. Nissan took the hit and was largely back online in 2 months, largely because a lot of this supply chain and crisis preparedness work. And then I think another really interesting example here is Southwest Airlines. The airline business is a notoriously difficult, low margin industry, has a lot of risk and inherent volatility in it. So resilience is really important here. Southwest is the one airline that's basically always made a profit, even through COVID. And they've had, a few challenges. They have a very simple, low complexity business model, but they also made a major bet on the Boeing 737 that got grounded, the MAX jet. But they were able to flexibly overcome that. They had some protection on the strategy side by having less exposure to international business traveler. Their low cost model certainly gave them a lot of operating flexibility. And they've been well known for years for how they really thought strategically about financial risk and doing things like hedging oil prices. So a lot of focus serially through multiple crises in the airline industry that has separated Southwest from the pack. I should add they've also run with probably 1/3 the debt load of most of their major competitors. So very different kinds of moves here. The third myth we talked about is this idea that the future shock will look like the last one. And I see this a lot with COVID right now. When I talk to clients across industries, there's a lot of work being done to say, how do we make sure we never get knocked off our game again by a pandemic, which I think is good, but the next crisis is not necessarily likely to be a pandemic. We're putting a huge amount of investment into work from home technology and remote work and doing much more online. The next event is probably much more likely to be a cyber attack or a cyber issue of some sort than a pandemic. And that's not to make a specific prediction, but it's just to say that for your business, there's huge value in really going through a structured exercise to, number one, imagine the different things that could go wrong across these and other dimensions, but probably more importantly to think about, well, if something like this went wrong, how would it affect our business? What is the channel through which we could get into trouble and have a severe loss of revenue, a sudden unexpected cost? There are probably thousands of triggers that could cause a problem, but there's a relatively small number of ways that you actually get into trouble in terms of your cash flow or your balance sheet. And I just see surprisingly few companies really go through that structured exercise. Or if they do it in a risk silo, but not fully integrated into their strategic planning and board discussions. Which brings us to our kind of fourth myth here, which is this idea that risk and resilience can be outsourced to the risk function. And we included a Swedish example here in the spirit of the audience, Handelsbanken as a great exemplar of resilience in financial services. I think they're the oldest company on the Swedish stock exchange, and they've survived multiple crises, did not have to take government support even in 2008. And I think at the heart of this, from a resilience perspective, was a strong model of kind of local empowerment and decision-making, and really creating managers who thought comprehensively about risk as well as growth and profit. Very flat hierarchy and organizational structure, and a very significant part of their compensation system tied to long-term performance. So a retirement plan that really paid out only when you retired and gave the incentive for managers to think long-term. Now, I know that Handelsbanken, I think, has struggled a little bit more in recent years with some of the changes around digital, and maybe hasn't moved quite as quickly on some of these as some of their peers, which takes me back to the earlier comment around you need both adaptability and resilience. But from a resilience perspective, we thought they're a very good example of kind of broad management ownership of risk rather than overly delegating it to the risk function. And then the final topic I wanted to hit here before turning it over to Hernan is this idea that, this all sounds great, but how do I afford it? And in particular, how do I have a dialogue with my investors around if I'm going to do three things to buy down risk and to increase resilience, that might have a short-term cost to my P&L. And so we wanted to understand the degree to which there are some of these trade-offs, and we developed what we call the Bain Resilience Index, which is a set of metrics looking at things like scale, profitability, operating leverage, financial leverage, industry mix, and how do those relate to companies' vulnerability to major shocks. So a higher index score here is better and means that you're more resilient. We've looked at this across all advanced economies, including the Nordics. We've done some deeper dives in the US. And perhaps not surprisingly, the first point is that there seem to be different levels of resilience, across industries. So consumer products as an industry, industrials, retail, have tended to be more resilient than things like healthcare and telecom and resources. You can see the bars here are kind of the average of all advanced economies, and the purple lines are the Nordics. So, in this set of markets, on average, there's probably somewhat higher resilience, particularly for some of the low resilience industries relative to the global average. But the second point I would make is that there's widespread variation within an industry. So if the bars are the median company, you can see a huge spread between the most resilient companies and the least resilient companies in these industries, or bottom and top quartile. And, these numbers, this is an index, so it may not be intuitive, but numbers like 40, 50% on this index are pretty bad. It's indicative of a real issue with resilience. And what does that kind of translate into in terms of short-term trade-offs with profitability and value creation? We looked at this across a 20-year period. We basically broke this index into kind of high resilient companies and less resilient companies. And, as you might expect, just from a kind of corporate finance theory perspective, there is a slight premium for some of the companies that have run with lower resilience over the 20-year period. That's that's the red line here, which has, and if you look at the red dotted line, you can see very slight average total shareholder returns during this period. Even that slight premium probably overstates the true performance of this group, because it doesn't account for the fact that some of these low resilient companies failed and wouldn't be in this index for all 20 years. And so there's some survivor bias even built into this view. But if we take this picture and we say, all right, well, there may be a slight premium from being willing to run with lower resilience, what's the downside of that? And I think the really important point is on this next page here. The downside is that those lower resilient companies have almost twice the risk of going out of business or being acquired over this 20-year period. So I think the question, and I found this helpful in dialogues with investors, is to just say, how do we think about the trade-offs between perhaps slight outperformance over any given period? If I go back and I look at this previous page, you can really see, especially that when times are good, the red line does better, but a significantly higher risk of an adverse outcome over the period. Andre mentioned the World Economic Forum. I've done a lot of work with them and their insurance and asset management group this year, and that's a set of long-term investors. They would all love to have a set of tools and metrics to have dialogues with the companies they invest in around this trade-off exactly. And how do I start to get conviction that it's worth perhaps doing things that might sacrifice some margin in the short term to really de-risk some of the really bad outcomes and improve the long-term risk of survivability. So I realize that was a very quick spin through, but I'm going to turn it over to Hernan and let him go through a few additional views, and then we'll open it up to questions.
Thank you, Andrew. And what I wanted to do is really go deep into one of these categories. And, Andrew has given us a good sense of what do you guys hear? Is everyone hearing an echo?
Yes.
If everyone can mute, that would be great. Can you hear me now? Give me a thumbs up. Super. So Andrew took us through the myths of resilience, or at least that's how we framed our insights. But it's hard to sort of grasp it at the high level. So let me go deep into one area where we're seeing a lot of activity, and that's operations. If you ask supply chain teams all over the world after 2020, what are they looking at? And the left-hand side of this page gives you a sense of that. Folks are looking at, how do I add flexibility? How do I add resilience? How do I keep business continuity going? And they'll literally admit, look, I'm less worried about costs. I am less worried about speed. and this is literally what we're observing across all of the industries, which is there is a move towards operational resilience. Why? Well, I think we're all aware, right? There was big issues with tariffs, particularly with regard to China early in the year. There were interruptions based on climate. And then, of course, the pandemic hit. The pandemic has created all types of issues. First, it was supply. Then it was actually distribution and the ability to get cargo space from China. Now, again, it's supply, etc. So this is literally what is happening today. Now, is this new? Is this a new thing? And let's go to the next page. And the answer is it's not new. Historically, I'll use an illustrative chart, right? There's always been some level of supply chain risk and some level of supply chain resilience investment. But traditionally, the risk exposure has been relatively low. And so we have built these very long supply chains, highly optimized. They have a very low sort of landed cost. And what happened, as Andrew said, all types of risks have actually become sort of prevalent in the economy. And we've moved from point A to point B. Right, so we are in a world today with a relatively high level of supply chain risk exposure, and we have not adapted the resilience. And that is why many companies around the world have stockouts. That's why what happened in the Suez Canal was so disruptive, because we were already in stockout mode. Now we added 3 weeks to that. What is happening in the world? Folks are moving from B back to C, right? And the data you saw in the prior slide literally tells you there's a trade-off. People are saying, look, I do not need the lowest landed cost that I could actually hit before. And so this is literally what's happening. Again, I'm giving you an example because this type of trade-off is the one that actually is being experienced on strategic resilience, on operational resilience, on organizational resilience, on technological resilience. And the complexity and the reason why you cannot outsource this to some risk function is evident in the next page, which is the devil is in the detail, and the detail is quite complicated, and it is very functionally expertise relevant. So, for example, if you are in a world of supply chains, what risks might you be looking at? You look at your industry and what that value chain looks like. You're looking at the length of that supply chain, the partners you have in every node, which nodes may actually break or not. Are those supply chain bases stable? What about the labor pools in those markets? What about the technology interfaces? There is a lot that you need to understand to make sure that these supply chains don't break. Today, right, we are not able to make cars in the world because there are no chips, right? We didn't expect that to happen. And then the resilience itself is also functionally expertise driven, right? So in supply chain or in operations, we are looking at how can I have multiple fulfillment options? How do I create multiple manufacturing nodes? Can I create real-time visibility, not only of the tier 1 of my supply chain, but tier 2 and tier 3? Is there any way to predict which markets may not be able to supply for me? Right? Do I have flexible workforce configurations, etc.? So this hopefully brings to life in a level of detail some of these very relevant trade-offs. Now let me step back. What does good look like? As Andrew said, many of our clients are asking us to do this work or asking us, have we become resilient enough? What do we think is the best practice? And that's on the next page. It really is 3 things, and it won't surprise you, but I'll try to bring it to life again. The first one is you really need to assess your exposures. And that assessment starts with what are the true vulnerabilities for your sector and your company? How do those compare to others that you are competing with versus your peers? And then which ones actually matter? And what that requires is to look at your P&L and at your balance sheet and say, if these things happen, when do I actually get into trouble? So that is the first part of the fact base. The second part is, what does trouble mean? What am I trying to protect? And as Andrew said, right, we've been trying to protect against earnings misses on a quarterly basis, but that's probably not the right way to think about resilience. There are other things. What about a liquidity crisis? What about a covenant breach? What about a solvency crisis? What about a potential bankruptcy? And what is my tolerance level? Again, this will be a choice between economic performance and resilience in most cases. And the last thing is, based on that objective and based on those exposures, what is your game plan? What is your game plan? Is where are you going to invest? Who is going to manage the resilience? That is a key organizational issue, right? The traditional risk committee is not going to be able to do that for you. And who do you have to communicate this with? Because we are convinced that the investor community will want to understand your resilience and will likely separate and value firms differently that are investing in resilience versus those that are not. I'll cover just 3 more slides and we will do Q&A, but I want to bring these to life. So how does one assess exposures? Again, I'll go into a detailed example, operations, because it's helpful. Right? Operations can break because of a supply base, a manufacturing disruption, a distribution disruption, a customer base disruption, that is a supply shock, a technical or technology disruption, or other external risks. Each of those can be actually modeled into a revenue impact, a cash impact, a cost impact, etc. And we can actually get a sense once we run it through our P&L, balance sheet, and cash flow statement. Is it catastrophic? Is it significant? Or is it absorbable? And that's the type of analysis that needs to be done. Once you know that, then you determine what level of risk you actually want to manage against. And just to give you a sense, right, it sounds like an easy choice. What level of risk do I want to manage? And Andrew, go to the next page, right? The answer is no. Actually, what you're protecting against needs to be very clear. It can be as simple as the earnings miss of a quarter or two, or a liquidity crunch in the short term. It might be a rating downgrade. It might be a covenant breach, all the way to I do not want to go bankrupt. As you go to the right, you become less conservative, but you have to invest less in resilience. As you move to the left, you become more and more conservative. There is a balance, and the conversation with investors and understanding your investor preferences becomes absolutely critical. And I will close with one final slide. And this is why the organizational component is so important. Ultimately, a resilience strategy and a resilience plan has components along each of the dimensions that Andrew mentioned earlier today. There are strategic investments to diversify the profit pool, investments to make sure that your balance sheet is secure, investments, as I just discussed, to make sure of continuity of operations in business or potentially reduction of the fixed cost structure, investments in making sure that the technology, has the cyber protection and the extra loops, and then investments in organization that can actually react. And to do this, you need an organizational model that can deploy this, which is no longer the enterprise risk management function. And communicating this against to the stakeholders becomes incredibly important. But this is where we're seeing, when we look at this page specifically written for a company, we're like, bingo, you actually have a true resilience plan. So with that, why don't we move into some Q&A?
Great. Thank you, Hernan, and thank you, Andrew. Great presentations and great insight to building resilience. So yeah, let's jump into the Q&A, where we'll be assisted by both Andre and my Nordic colleagues. So please write your questions in the chat function as we move along, and we'll do our best to field all the questions we get. So looks like we have one from Jason. Jason, you want to just ask that question to Andre straight off?
Yeah, no, thanks, Steve, and thank you both gentlemen for your presentations. I would love to hear Andre's perspectives on some of the Nordic kind of perspectives on the index and where he sees some deviation.
I think it's a good question. I think as Andrew and Hernan said, Nordics is doing pretty well in terms of resilience on the index. So you can see that the Nordics is above kind of advanced economies in multiple. I'm not surprised on resources and utilities. We all know that there's a big push in the Nordics towards renewables. And I'm not surprised that the resilience within the renewables is less volatile than the carbon fuels. So that would be my first reaction. And my second reaction is we're just working with companies in the Nordics. There is definitely a view that the companies need to think through not just the kind of the underlying growth, but also the potential disruptions that are coming. So that's definitely has been a focal point of our work with the companies. So that to me, the slide actually reflects that. So I'm not surprised that the Nordic is doing quite well compared to the advanced economies.
What about healthcare, Andre?
That's well, yeah, the Nordics on healthcare on the slide is below the advanced economies. Clearly, there's push, especially in Denmark. Healthcare is Denmark is pushing it above its weight in healthcare, and I think healthcare is a big growth area for Denmark. I'm a bit surprised that resilience is below advanced economies. To me, that would be maybe it's because it's a Nordics index, not Denmark specific, but for Denmark, to me, that'd be one of the areas where Denmark would actually excel.
Good, thanks. Alexandra, do you have a question?
I do indeed. Thank you, gentlemen, so much for your presentation. Hernan, when you were talking about the game plan and setting your game plan and getting ready to really dive into resilience, I wanted to ask you, you teased a little about deciding who is going to manage resilience inside your company and how do you decide this? And I wanted to ask if you could expand on that and maybe share some of your recommendations based on your experiences. Would you set this as a responsibility in multiple roles, multiple departments, or have a single point of contact? How would you deal with this, Hernan? Thank you.
That is a great question, Alexandra. And let me remind us of why did we use the Swedish bank example here, right? Which you may be like, what are they talking about? You know, and I'm trying to contrast the way that most of us in companies have managed risk in the past, which is there's an enterprise risk management function sitting at corporate or in the board, and they are supposed to be managing risk. Why did we think that Handelsbanken was so interesting, right? It's because it's basically distributed and leadership throughout the organization in a highly entrepreneurial and long-term way. And what we're saying is, take that analogy and think about it, right? So, for example, does the IT department need to play a fundamental role in managing technological risk? Yes. Right? Should the operations and marketing functions, as they think about the product lineup, think about the operational risk, operating leverage? Yes. Right? As we're thinking about designing our facilities, our footprint, right? Should our HR teams be thinking ahead, right? Of when might we have labor force disruptions so that we can actually be resilient? The answer is yes. And so the short answer is this is a distributed responsibility. So what is the likely model going to look like? Of course, there's going to be a small central group that is going to be cross-functional, that is currently thinking, constantly thinking, what are the risks and how do I adjust? And talking to one another, right? Cross-sharing how they're thinking about the disruptions, because that's, you always want to know what others are thinking about disruptions, but applying it to their function. And we think that the frontline management is going to be incredibly helpful in doing this in the future. And again, I'm contrasting that versus the way that many companies have run enterprise risk management, which is a checklist with checks that gets presented to the board every quarter. That is not nearly as helpful, right? As, for example, a supply chain manager with a digital, twin of a supply chain saying, I'm about to have a disruption in this part of the world. How do I shift production? Right? This customer call center may shut down. Where do I move that volume? Right, etc. Andrew, anything you would add to that?
I think it's well summarized, Hernan. The only thing I would add is I think fundamentally this issue needs to be owned by the CEO and the board. And sometimes it can get delegated down too much, or even in those examples Hernan gave where you might have a risk committee that sends a report to the board. It's item 7 on day 2 of the board offsite, and it's a box checking exercise, as opposed to this is actually a central topic. One of the most important roles of the board as the kind of stewards of the company's long-term viability. And and the practical implication of that, as we think about how do we get this better joined up with strategic planning, is CEOs and their management teams should be having explicit discussions around all of these questions. What's our risk and resilience appetite? How would we make some of these trade-offs? In financial services, I think they're more advanced on this topic because they've had to be. We've lived through a financial crisis. We have regulators requiring it. We have living wills and stress tests and a whole bunch of tools. I think the resources industry does a lot of this as well because they're also making, multi-billion-dollar, multi-decade capital decisions. Some other industries, it's just less of a natural motion.
That makes a lot of sense. And it sounds like an organizational mindset also that changes when you start looking at resilience versus other topics. I see that there are plenty of questions in the meeting chat.
Yeah, and maybe Alexander, I was thinking maybe Peter, since he had Lars Naslund on the board, he's a good friend of all the Nordics, but maybe Peter, you can ask Lars to join us and ask his question.
Sure.
Yeah.
Well, I won't even wait for Peter's answer to that. Hi, so I'm Lars Naslund. I used to be on the AmCham board. I'm currently residing in Minnesota, so I am kind of sneaking into these great Nordic sessions. Now, I was thinking about because I didn't see the services sectors in your resilience index chart. I didn't see any service sectors, primarily not thinking maybe about restaurants, but looking at, well, I think it's a great example, a certain type of consultants where minor just service companies they don't experience the supply chain disruption. They don't experience the same type of challenges in this situation like this, or even in the financial crisis. They're into a whole different type of challenges. How do you measure, how do you look at resilience in those industries?
Well, since you mentioned consultants, Hernan, I mean, we can share a little bit how we've thought about this at Bain, because I think we're a pretty interesting case study. We're a very global business. And so like many of you who may also have global businesses, we experienced COVID early on in our Asia offices, and then it rolled into Europe, and then it rolled into North and then South America. So, part of it was having just very quick feedback loops around understanding lessons from one market and being able to plan and move quickly in other markets. This is maybe the intersection of adaptability and resilience. Actually, I'll bring prediction into it for a minute as well, because we were tracking COVID as early as December of 2019, when some of the first reports were coming out in China. And I think it developed a point of view, maybe like a week or so before that became conventional wisdom, I would say. And that actually a week made a big difference in the early days of markets going into shutdown. We have a very diversified business across countries and industries. And I think that helped. Just because some industries actually had and types of work had significant needs at a time when others were maybe less able to do work with us. Operationally, we had all the same issues that I'm sure many or all of you have had around how do you move from an in-office environment to a work from home environment? How do you configure your technology to be able to do that? Longer term resilience, we worry, as I'm sure again many of you do, about the impact on culture and relationships and mentoring, which is really critical in our business, where every year we hire large numbers of people. We've now had a whole class that's never met any of their colleagues. So we've had to, I guess my point is just all of these issues are very real still in a services business. We've grappled with them. the factors that Hernan talked about around, what really helps drive strength, enough diversification, certainly scale, profitability, planning, technology capabilities, and this organizational resilience and kind of the bank of goodwill you have in your employees to tap into have been critical things we found in our experience. I don't know, Hernan, if you'd add anything.
Yeah, I'll take the other industry that Lars mentioned, hospitality. So Lars, you are absolutely correct. There was no supply shock to hospitality, right? The planes were available, the hotels were available, and the restaurants would have stayed open. There was a demand shock. And by the way, one of the most extreme demand shocks, right? Because folks might have said, no, I have a reasonably diversified profit pool. And it's like, well, apparently for this particular shock, not diversified enough. But actually what happened, right? Which is individuals that were resilient or companies that were resilient reinvented their business models to diversify the profit pool. I'll give you some interesting examples. Some of them you may have heard of, some of them may not have heard. Hotels in the United States close to college campuses offered themselves to actually shut down as hotels to become the COVID house of colleges and universities. And that's where you were able to isolate individuals, right, that would not take space in a hospital where the adults would be for the young population that needed to be managed. So all of a sudden I went from being utilized pre-COVID to 0% utilization to actually a high level of utilization, perhaps at a different price point. A reinvention of the business model. What happened in the restaurant industry in the United States, you may have observed similar things in the Nordics, right? Every restaurant, right, that had not become a delivery business became a delivery business, right? And so all of a sudden, 200 euro meals were appearing in your house in a motorcycle. That had not happened in the world before, but actually started happening, right? And so there was a reinvention, right? And Southwest is a wonderful example of this, right? Many airlines in the world depend on business travel and international travel to make money, right? International travel is quite depressed right now. Business travel is quite depressed right now, right? The fact that Southwest has an incredibly profitable business, including domestic, traditional domestic, right, allowed them to actually weather this crisis a lot better. So in that case, right, you go to the strategic side and say, what types of shocks could I get on my demand side? How concentrated is my profit pool? How can I actually orient my business model? Another thing that some hotels did is they became offices for people who didn't have a home office, right? A relatively safe place to go and actually, so that reinvention has become really important. That's an extreme, but it should be but it illustrates the thinking that we need to do from a strategic perspective regarding profit pools.
Good. Thank you. And Peter, did you have a question? Thanks, Lars, by the way. And Peter, do you have something burning?
I had a couple of burning questions, but I'll keep it to one, and that is more like, and Andrew, you touched on this in terms of long-term stewardship, but I'm wondering like how your research on resilience ties into the like larger, longer trend of investors and consumers demanding, environmental, social, and governance (ESG) criteria for the companies that they buy from or invest in. And I think it has implications for the risks that you mentioned being accelerated around geopolitics and social polarization and technology and more. So I was just wondering, how does your research tie into that trend?
Yeah, it's a great question, and this was at the heart of the work we did with the World Economic Forum with their insurance and asset management group, because all of those companies were very focused on ESG, excuse me, on sustainability broadly defined, and they're getting more pressure from their constituents, stakeholders, regulators, especially in Europe. I think this is an area where Europe is way ahead of the US and Asia. And so they were already paying a lot of attention and asking the question around, you think about insurance and asset managers, they're huge allocators of capital. And how do we bring the sustainability angle into some of those decisions we make? Resilience then, I would say, is highly related and overlapping, but a little bit different and expanding the circle in the sense of some of the metrics that we talked about here in the resilience index or in Hernan's page of operational factors wouldn't necessarily show up on an ESG scorecard. So they're trying to figure out, are there ways we can evaluate resilience? And is resilience also linked to good practices around sustainability? I suspect it is, because the root cause of both of them, or the common element, would be a management team that actually thinks very long term. One of the challenges I've observed in the ESG space is just there are so many different ratings, approaches, and frameworks and firms that are trying to shape what you even look at, that it's a little bit like the Wild West, and there are no standards right now because there are so many different ones. And if you now throw resilience on top of it, the risk is that you create more complexity, more management complexity, more reporting complexity. So what everybody said is give us more metrics, but please don't, we're not asking for more like, living wills or stress test levels of documentation and, spending a ton more hours preparing financial statements. And I think that's a tension that still has to be, navigated, honestly. But I think this idea that, we need to be open to a broader range of risks and have a different time horizon around how we think about value creation. They're well primed for that in that industry. And I think that is spreading across more industries and more geographies.
But Peter, you're pointing to something incredibly important, right? Capital allocation in the past has moved towards profitability, growth and profits. Let me move capital in that direction, and that was the primary reason. I mean, on a risk-adjusted basis, I'll just put it where there's profitable growth. What has happened with ESG, right? It's basically said, look, there's big allocators of capital like BlackRock saying, you know what? I'm going to have green portfolios and brown portfolios. And once you're in the green, right, your access to capital is going to be better and cheaper. My expectation is that trend, once, as Andrew says, the craziness of metrics gets solved, is that investors will be far more sophisticated. And they will say, okay, there's a profitability, there's a sustainability track record, and I'm going to ask you, what's your resilience track record? Because there is so much turbulence happening in the world in so many ways that we will actually have to measure this and report it, and people will expect it.
Good. Thanks for that. And I know our last question, I think Jakob just had to leave the call, but if he's still there, maybe I should ask it because it is a good question. So can you share examples of how to work with organizational resilience? We know that employee engagement are strongly impacted in times of crises and when there are high level of uncertainties. So when do you write, invest in employee engagement? That could be example. What could be examples of that?
Yeah, I mean, like anything else, a lot of this depends on some of the investments you make before the crisis. And so if you wait until you enter the crisis, it's kind of too late. So I would say on the last part of that question, the time to invest in employee engagement is, during the good times, well before the crisis hits. And I would also assert that engagement is probably too low a bar. We should be looking for employee inspiration. And I don't use that word lightly, but if you actually ask that question, you see companies that do well on that dimension just get much higher levels of that discretionary energy and time and loyalty. And you get employees willing to do all the heroic things that we saw, especially in the early days of the crisis, when people were figuring out, how do I get 10,000 people in my workforce, laptops and access to a network so they can work from home overnight? How do I answer a backlog of calls in a call center, when it crashed for 3 days as we made the initial move? How do I take care of customers? That kind of energy comes from more inspired and engaged employee bases. So I think that's probably step one. I do think there's something as well to really just understanding. There's an organizational design element. How do I create a flexible organization with capability in different locations and in different parts of the company? And then there's an individual skill set and mindset question. And one of the things, I haven't really seen people doing this yet, but I think we will see more companies in the kind of employee assessment phase, building in, questions and skill progressions and training programs to help assess and develop personal resilience, growth mindsets and those sorts of characteristics. I don't know, Hernan, if you'd add anything there.
No, the only thing is that tango between individual resilience driven by inspiration and organizational resilience driven by flexibility, agility, and crisis preparedness is where we have seen great things, right? It is where we saw people cleaning up their call center backlogs. And so you want to think about that duo.
Well, gentlemen, we're out of time. I think we need to round out here. We've reached 4 o'clock in our time anyway zone. So I know it's different in your time zones, but people are starting to drop off. So let me just really quickly thank you, Hernan and Andrew. Great session, really interesting and relevant discussion, and really unique insight from the Bain report. So, and I know we'll be sharing this with people afterwards. And if we have further questions, we'll certainly get them to you. And so thanks again also to Bain and Andre for your partnership on this. It's been great. We really appreciate that. And finally, to my colleagues, Peter, Alexandra, and Jason, thanks again. It's always great working with you guys. So I hope you all stick on the line. We can chat a bit as we round out, but that does wrap up the program for today. So thanks for joining and please stay safe.
All right.